This topic is about historical return and risk from learning module Portfolio Risk and Return, Part 1. The pattern described is a positive relationship. As risk goes up, return goes up. Investor will choose a risky stock over a safe bond, only if they expect it to be paid more for the trouble. This extra payment for taking risk is called a risk premium. The fact that the market has to offer this extra return to get people to buy risky assets proves that the average investor dislikes risk, or risk-averse. Risk-averse investors need to be compensated for taking on uncertainty. Therefore, higher risk must lead to higher expected returns. A risk-neutral investor only cares about the return, not the risk. In a world of risk-neutral investors, you wouldn't necessarily see higher returns just for taking more risk. A risk-seeking investor actually enjoys the gamble and might even accept a lower return just for the chance to play. More risk equals more expected reward. According to historical data, the order of risk from lowest to highest is treasury bills, bonds, stocks. T-bills are at the bottom, safest or lowest pay, and small company stocks are usually at the top, the riskiest or highest pay. Treasury bills are the safest baseline asset. Since they have the lowest risk, they naturally offer the lowest returns. Option C is correct. Option A is wrong because if an asset has higher returns, it must also have higher risk than the safer asset. Option B is wrong because stocks are riskier than bonds. Therefore, they should provide higher returns, not lower. This topic is about other investment characteristics. The answer is C. Total trading cost usually includes brokerage commission fee, bid-ask spread, price impact from large orders. Bid-ask spread and price impact come from the securities market liquidity. More liquid security, narrower spread, and smaller price impact. Less liquid security, wider spread, and bigger price impact. These are market-driven. Brokerage commission fee is charged by the broker for executing the trade. It is agreed or negotiated between the investor and the broker, or based on the broker's schedule. It does not depend directly on the security's liquidity. This topic is about risk aversion and portfolio selection. The answer is C. Risk-free asset has zero risk. Standard deviation equals zero. Its return is certain. Utility for risk-averse investors depends on expected return and risk. When risk equals zero, utility depends only on the expected return. All investors face the same risk-free return, same number. Because risk is zero, no difference comes from risk aversion level. Utility from the risk-free asset is therefore identical for everyone. Option A is wrong because more risk-averse does not get higher utility from zero-risk asset. Option B is wrong because utility here does not depend on different expected returns. Risk-free return is the same for everyone. This topic is about utility theory and indifference curves. Correct answer is B. Indifference curve shows all combinations of expected return and risk that give the same utility level to one investor. For risk-averse investors, the curve slopes upward because more risk requires higher expected return to keep utility the same. A more risk-averse investor hates risk more strongly. For the same small increase in risk, they demand a larger increase in expected return to stay equally happy. On the graph, this larger required extra return for the same risk increase makes the curve rise faster. Steeper slope at every risk level. Steepness measures how much extra return is needed to accept more risk. The key difference between different levels of risk aversion. Curvature exists for all risk-averse investors, but the degree of steepness, the slope, is what separates more averse from less averse investors at the same risk level. Option A, higher curvature, is not the main distinguishing feature curriculum uses for comparing levels of aversion. Option C, lower intercept, does not relate to risk aversion level. Correct answer is B. Memorize the utility formula. Best investment is the highest U. High risk aversion coefficient makes the risk penalty very large. Even though Fund Q has higher return than Fund P, its risk penalty is still small enough to give higher utility than Fund P. Fund R has biggest risk, biggest penalty, lowest utility. Lower risk aversion coefficient, A equal 1.5, means the risk penalty is smaller than for highly risk-averse investors, A equals 5. Beta offers a good balance, much higher return than alpha, with risk penalty that is still acceptable. Gamma has highest return, but the very high risk, 18%, creates a larger penalty that reduces utility below beta. For lower risk aversion, investors accept more risk for higher return. For a risk seeker, the risk part of the formula acts as a bonus rather than a penalty. Option 3 does not have the highest return, 11% versus option 1's 12%. However, because this investor loves risk, the high standard deviation, 25%, creates such a large utility boost that it becomes their favorite choice. When the risk aversion coefficient equals 0, investor is risk neutral. Risk neutral investor cares only about expected return. Standard deviation does not affect utility at all. Asset with highest expected return is always chosen no matter how high the risk is. Utility equals expected return minus risk penalty. If A is greater than 0, penalty is positive. Higher risk lowers utility. It means investor dislikes risk, a risk averse. If A is lesser than 0, penalty becomes negative. Higher risk increases utility. It means investor likes risk, a risk seeking. Option A, coefficient A equals 3. Penalty becomes positive. It's risk averse. Option B, coefficient A equals negative 2. Penalty becomes negative. It's risk seeking. Option C, coefficient A equals 1. Penalty becomes positive. It's risk averse. Only negative A makes investors prefer more risk. Option A is correct. Both investors have the same capital allocation line, or CAL. The CAL shows all possible mixes of the risk-free asset and the risky portfolio. Each investor picks the mix that matches their risk preference. A is the risk aversion coefficient. Higher A means more risk averse. They want less risk. Lower A means less risk averse. They can handle more risk for higher return. The CAL slopes upward. Left side is all in risk-free asset. Low return, zero risk. Right side is all in risky portfolio. Higher return, higher risk. Further right means borrow to invest even more in risky portfolio, even higher return and risk. So moving right on the CAL means higher expected return but higher risk. Bailey chooses closer to the left, more in risk-free, less in risky. It means lower expected return. Alex chooses further right, more in risky. It means higher expected return. This topic is about application of utility theory to portfolio selection. Two-fund separation theorem explains that all investors will combine a risk-free asset like T-bills and a single optimal risky portfolio, the same for everyone. This optimal risky portfolio is the one where the line from the risk-free rate just touches or is tangent to the efficient frontier. It's not chosen based on any one investor's preferences that comes later when they decide how much to put in it versus the risk-free asset. It's the portfolio that gives the highest slope, reward to risk ratio, when combined with the risk-free rate. This slope is called the Sharpe ratio, and this portfolio maximizes it. That's why it's optimal for everyone. Option B is correct. The optimal risky portfolio is the same for all investors, not customized yet. Option C is incorrect. Only the one at the tangency point is optimal for combining with the risk-free asset. Investors differ only in where they sit on that line, based on their risk aversion, not in which risky portfolio they hold. This topic is about portfolio risk and portfolio of two risky assets. Portfolio standard deviation depends on weights, individual standard deviations, and correlation, not just weighted average of risks. Correlation 0.3 is less than 1, means diversification benefit exists. Portfolio risk lower than weighted average of individual risks. If correlation was 1, portfolio risk would be 19%, much higher. Here correlation 0.3 reduces risk noticeably. Negative covariance minus 0.01 means assets move in opposite directions. Strong diversification benefit. This reduces portfolio variance a lot. Portfolio risk is much lower than weighted average of individual risks, 11.6%. Negative covariance is key reason risk drops significantly. When correlation equals 1, portfolio standard deviation equals weighted average of individual standard deviations. Maximum possible portfolio risk. When correlation is less than 1, portfolio standard deviation is lower than that weighted average. Diversification benefit exists. When correlation is less than 0, portfolio standard deviation would be even lower. Strong diversification. Here, 18% is below 20.4%, but not extremely low. Correlation positive, but less than 1. Portfolio variance equals sum of weighted individual variances plus covariance term. Given portfolio standard deviation 19% is higher than weighted average of individual standard deviations. When portfolio standard deviation equals weighted average of individual standard deviations, correlation equals 1. Here, covariance equals 1 multiplied by 0.15 multiplied by 0.25 equals 0.0375. Portfolio expected return is always a simple weighted average of the asset's expected returns. No risk or correlation is needed for expected return calculation. The weight is higher in the stock with higher expected return to pull the portfolio return up toward 7%, from beta's 4% toward alpha's 9%. 60% in alpha gives exactly 7.0%. Negative correlation minus 0.2 reduces portfolio risk below the level when correlation is 0. When correlation equals 0, portfolio standard deviation would be 12.73%. Negative correlation gives extra diversification benefit, so risk drops to about 11.38%. Equal weights and equal individual risks make calculation symmetric and simple. While both individual assets have a risk of 18%, the combined portfolio risk is only 11.38%. This happens because when one asset goes down, the other is likely to stay steady or go up, canceling out some of the volatility. Diversification in action. Since the correlation is less than +1, the portfolio risk must be lower than the weighted average of the individual risk, 18%. When correlation equals 0, the covariance term disappears. Portfolio variance becomes average of individual variances because equal weights. Portfolio standard deviation equals 21.21%. This shows diversification benefit even when correlation is 0 or not negative. Option B is correct. Lower correlation equals more diversification equals lower portfolio risk. Higher correlation equals less diversification equals higher portfolio risk. When correlation equals +1, there is no diversification. Risk is just the weighted average. When correlation is lower, risk is less than that weighted average. So if correlation increases, you lose some of that diversification benefit, so risk goes up. Correlation rising from 0.2 to 0.6 means the assets move more in the same direction. That reduces the benefit of combining them, so the portfolio becomes riskier. Covariance equals correlation times standard deviation A times standard deviation B. Variances are given, so take square root to get standard deviations first. Correlation 0.6 means positive relationship between returns. Notice equal weights and different individual risks. Positive correlation 0.2 means some diversification benefit exists, but not maximum. Maximum benefit at correlation equals -1. Portfolio standard deviation falls between the lower individual risk, 6%, and the weighted average, 8%. Weighted average risk equals 0.5 times 6% plus 0.5 times 10% equals 8%. Portfolio risk 6.3% is clearly lower than 8% because correlation is less than 1. Negative correlation minus 0.3 creates strong diversification benefit. Portfolio risk becomes much lower than weighted average of individual risks. Weighted average risk is 8%, is from 0.3 times 15% plus 0.7 times 5%. Portfolio standard deviation 4.8% is clearly below 8% because of negative correlation. Negative correlation reduces risk below what happens at correlation equals 0. The answer is A. Covariance equals correlation times standard deviation x times standard deviation y. Variance is given, so take square root to get standard deviation. Correlation 0.6 means positive relationship. B is correct. Lower correlation always gives more diversification benefit, lower portfolio risk. Negative correlation gives the strongest reduction in volatility because assets tend to move in opposite directions. Among the choices, negative 0.1 is the lowest correlation, maximum risk reduction. Correlation 0.6 is high positive, the least risk reduction. Weighted average of standard deviations equals 17%. It's calculated from 0.3 times 10% plus 0.7 times 20%. Portfolio standard deviation 15.98% is lower than 17% because correlation equals 0.6 is less than 1. Positive correlation 0.6 limits diversification benefit, but still reduces risk below weighted average. If correlation was 1, portfolio standard deviation would be exactly 17%.